Welcome to the Probability Brief, the signal check on the world's most telling prediction markets. Today is Monday, March 2, 2026, the liquidity drift and the regulatory horizon. The Probability Brief's objective is to deliver clear, data-driven intelligence on how major events are being priced in real time. Each episode examines fast-moving prediction markets, high-impact whale trades, regulatory momentum, and shifts in crowd psychology. We explain what moved, why it changed, and what the probabilities reveal about the path ahead, making complex market signals accessible, actionable, and easy for listeners to follow. In today's briefing, we are not just reporting the news, but analyzing how the world reacts to it. We are diving deep into probability ecosystems to understand why certain narratives are gaining traction while others collapse under the weight of new data. Signal mechanics: why a narrative collapses overnight. We begin with signal mechanics, where we look at how information propagates through a market. Over the last 48 hours, we witnessed a classic case of narrative decay. A long-standing expectation regarding a shift in international trade policy, which had been priced at a 65% probability, plummeted to 15% in a single trading session. Why does a narrative collapse so quickly? It often comes down to information asymmetry. While the general public sees the surface-level headline, sophisticated traders monitor quiet regulatory filings or subtle shifts in liquidity. When a high-impact whale trade occurs, it often creates a cascade. In this instance, a few large players exited their positions early, signaling to the rest of the market that the inside information had changed. This triggered a confirmation cascade, where traders sell not because the news is bad, but because they see others selling and assume the others know something they don't. Market microstories: the 2 a.m. liquidity spike. Moving to our market microstories, we highlight a small but meaningful movement in the renewable energy adoption markets. At approximately 2 a.m. Eastern Standard Time, we observed a sudden liquidity spike. While 3% shifts in niche markets are often dismissed as noise, this movement was a correction of a mispriced market. The spike coincided with a late-night legislative release in a secondary jurisdiction. Traders who were awake and monitoring these obscure channels were able to capitalize on the lag before the broader probability ecosystem caught up. This is a teachable moment about incentive design. The reward for being first to a niche signal often outweighs the risk of low-volume trading. Structural context: geopolitical tensions and escalation pricing. In our structural context segment, we examine how markets are currently pricing geopolitical escalation. When tensions rise between major economic powers, we look for volatility clusters, periods where market prices swing wildly as they struggle to find a new equilibrium. Currently, the probability of a peaceful resolution in the ongoing maritime dispute has drifted lower. However, market microstructure reveals that while the odds of conflict are rising, the cost of protection, via hedging, has remained relatively stable. This suggests that while traders are nervous, they do not yet anticipate a systemic breakdown of disaster relief or supply chains. They are pricing in friction rather than fracture. Regulatory trajectory analysis: decoding agency signals. Instead of just reporting on the latest regulatory hurdles, we want to explain the legislative process behind them. We are currently tracking a shift in agency signals regarding decentralized finance. By breaking down committee dynamics, we can see that the incentives for key stakeholders are shifting toward more rigid oversight. Historical analogs suggest that when a regulatory leak shifts sentiment this early in the year, it is often a precursor to a formal legislative push in the second quarter. Traders are currently analyzing these leaks to determine which platforms will be designated as systemically important, a designation that carries both prestige and a heavy compliance burden. Crowd psychology deep dive: narrative anchoring. Crowd psychology is a goldmine for understanding market movements. Today, we are focusing on narrative anchoring. This occurs when traders become so attached to a specific story, such as the inevitability of a tech breakthrough, that they ignore contrary evidence. We are seeing overconfidence cycles in the AI adoption markets, where traders are pricing in 90% success rates for technologies that are still in the prototype phase. This is an example of attention scarcity. the hype is so loud that the technical hurdles are being overlooked. When the reality eventually hits, the resulting panic dip can be severe as the anchor is ripped away. Cross-market correlation, the ripple effect. In our cross-market correlation segment, we look at the when-then relationships. When liquidity dries up in the traditional tech sector, it often appears elsewhere, specifically in prediction markets focused on regulatory outcomes. We have noticed that when Market A, semiconductor futures, moves, Market B, export license probabilities, usually follows with a 4-hour lag. This correlation is a high-value signal for those who can bridge the gap between equity markets and probability ecosystems. The incentive map, who benefits from volatility? To truly differentiate our analysis, we look at the incentive map. In the current market climate, it is vital to ask, who benefits from a market moving? While most traders lose in high volatility environments, market makers and those providing liquidity thrive. We are seeing evidence of coordination among certain institutional players who are signaling strength in one domain while quietly de-risking in another. Identifying who is silent, such as major venture capital firms during a dip, is often just as telling as seeing who is loud. What traders missed, early signs of narrative decay. Finally, we wrap up with what traders missed this week. While most were focused on the high-profile Senate hearing transcripts, a quiet regulatory filing regarding carbon credit verification went virtually unnoticed. This is an undervalued signal. This small filing has the potential to shift the entire probability of the green energy sector's profitability over the next 3 years. It is an early sign of narrative decay for those betting solely on government subsidies without considering the tightening of verification standards. Episode summary and closing. In simple terms, today's market signals show us that while big headlines grab attention, the real movement is happening in the plumbing, the liquidity flows, and the quiet regulatory shifts. We saw how a single whale trade can collapse a narrative and how a 2 a.m. spike can signal a niche market correction. Understanding these patterns, the how and why of probability shifts, is what allows you to stay ahead of the crowd. Thank you for listening to the Probability Brief. If you found this valuable, please like, subscribe, follow, and share with someone who watches the odds like you do. The sources for today's episode are Polymarket, the Bureau of Labor Statistics, Twitter Trends, and Senate hearing transcripts. This podcast is for informational purposes only and does not constitute financial, investment, or betting advice. All market probabilities are subject to change. Episodes may be generated using fully original, market movements, whale trades, and regulatory signals. Some scenarios, market movements, or examples discussed in this episode may be illustrative or simulated for explanatory purposes.